Hi, welcome to Core Wealth's monthly wrap-up. We live in a world where there's a lot of noise in the sense of news that bombards us and can often make us feel nervous. Lots happened since our last monthly wrap-up video, but the two things I want to touch on are one, the GDP numbers that came out showing that our economy has shrunk since or during the first quarter of this year. That was predominantly due to the electricity power cuts or the blackouts because of Eskom's problems. The other big driver for the economic pullback was the drought in South Africa, again affecting the agricultural sector and a drag on the economy. The second point I want to touch on, which happened in the last few days, was the State of the Nation address, or SONA. There's been quite a lot of negativity coming from analysts and opposition parties saying that it wasn't concrete enough, there weren't enough deliverables. We're not that negative on what came out of SONA. We don't think that the State of the Nation address is there to give all the nitty-gritty detail of plans, and sure, there could probably have been more detail, but on the whole it addressed the main concerns. There's two main reasons why we want to ensure that investors don't become too conservative at this point in time. The first one is the valuations that we see in the local markets and global markets, as well as if we look back at patterns in history that could give us some idea of what tends to happen when we've seen a market environment similar to what we've had now. Now, it's understandable that investors could be nervous after periods, if we look at the last 5 years, of a balanced portfolio just really keeping up with cash. Now, that can often lead to one thinking, well, why don't I just keep my money in the bank? And the reason why that isn't a good idea is because over the long term, cash doesn't generate enough returns. We need returns to be well above inflation in order for anybody's wealth to grow. At the moment, the South African facing shares on the JSE, so companies that are generating profits from businesses in South Africa, there's in excess of a 30% upside, which over the last 5 years is one of the highest levels that it's been at, and even over the last 10 years is a very healthy upside to have. The non-South African facing shares on the JSE, so shares that we would typically call rand hedges, in other words generating revenue from outside of South Africa, those shares as well are looking at returns in excess of 20 to some of them even more than 25% if one looks into the future. Again, levels that we haven't seen for a number of years, implying and demonstrating that South African shares look attractive. The interesting thing is, if you look back over this period at all the times where you saw negative returns by balance funds, the following 3 to 4 years all saw healthy returns, way higher than the returns that you'd seen in the preceding 3 or 4 years prior to that negative return. An indicator, we believe, that we could see some very attractive returns even in 2019 and over the next 2 to 3 years. Now, we're not betting the farm in any one of our strategies. We don't put all our assets or all our eggs into one basket, and so we have diversified portfolios. But in order to achieve long-term growth, we do have more exposure to growth assets. Over the last 4 years, that's been a tough position to be in, but we do believe, based on the things I've just said, that over the next coming years we'll see that turn around. And the start of 2019 has probably been a good example of that. We don't know at which point, nobody rings a bell to tell you that equities are going to now start running, and this year we've seen exactly that. The end of 2018, it was a horrific year, and if one looked back you would think, well gee, we should just put all our money in the bank. The first 4 months of this year, as you would have seen from previous reports, were very good. We saw strong returns both locally and internationally from share markets, and that fed through into our portfolios of our clients. May wasn't a good month. in May we saw the local equity market and global equity markets both off more than 4%. And again, if you take that noise or that information together with the negativity coming out from the GDP growth and some of the negative comments around the SONA, one could be quite within your rights perhaps to think, well, again, I should just become very conservative. If we look at June, we're now 2/3 of the way through the month of June. Local and global stock markets are all up and have more than made up for the pullback that we saw in May. One has to remain focused on your long-term strategy and not try and call things in the short term. I hope this has given you some insight. Our message remains the same, that we need to stick to our long-term strategies. It has been a tough place to have been, although we've still had growth, but not as much as we'd wanted. And this is not the time to become conservative. Over the next coming months in these video reports, we'll be talking about some of the research that we've done to help you see the importance of staying focused on long-term strategies and the rewards that brings ultimately to you as the client in terms of growing your wealth. I hope this has been helpful. As usual, if you've got any questions, please by all means give us a call, get hold of your advisor, and we'd love to chat to you. Thanks very much.